Again, welcome to the company assignment number 1 live session, and we will be reviewing the company assignment 1 that you have. So let's look at the assignment and get things started. All right, so what I have here, bear with me one moment. Right, so this is the company assignment. Of course, the instructions page clearly indicates that the total is 50 points. Each question is worth 10 points. And then, of course, the due date is Sunday, November 18, and you need to submit by midnight. Now, I would strongly suggest that you try to work along with me, and hopefully you make lots of progress as you work along with me to the end. So let's delve right into the assignment. Question number 1. Find the disclosures regarding revenue recognition for your company in the summary of significant accounting policies. Now, let's remind ourselves that the summary of significant accounting policies note is part of the notes to the financial statements. All right? And generally, that is the first section of the notes to the financial statements. And note that these notes come right after the financial statements, and we will see that shortly. Now, briefly, in your own words, describe the point at which your company recognizes revenues. So this would be based upon the actual company that has been assigned, not the competitor. So if you are in the team that has been assigned Home Depot as the main company, that's what you will be doing this assignment for, this particular question. So for this question, you will do the revenue recognition brief discussion for Home Depot. If you were assigned Pfizer as the main company and Merck as the competitor, you are doing the revenue recognition for Pfizer. So let's get started with that. So what I'll do is I'll pull some of the financials. Let's get to CVS. So this is the financial statements of CVS. And this is the annual report for 2017. So that is for the year 2017, all right? And we go to page 52. So if you are analyzing CVS, page 52 will take you to the notes, all right? As you can see, notes to the financial statements. This comes after the financial statement itself, the actual financial statements, right? After that, we get to the notes. So let's get to page 52 again. So page 52 discusses the revenue recognition method or principle that is used by CVS to recognize revenues. Now, CVS has 2 main segments. It has the pharmacy services segment, and then it has the retail segment, the retail pharmacy, which we are all familiar with, right? The retail pharmacy, where you have the retail drugstores. So you need to look at the different types of segments and the revenue recognitions, briefly discuss it, but you need to talk about the different revenue recognition methods or principles that apply across the various segments of the business. So let's start off here briefly. So Pharmacy services segment sells prescription drugs directly through its mail service dispensing pharmacies, okay? And then indirectly through its retail pharmacy network. But the key is right here. Revenue is recognized when persuasive evidence of an arrangement exists. Remember, there should be an agreement, a contract, an order. But that is not alone as the requirement. Second, delivery has occurred. And this should remind us about the revenue recognition principle. What must happen before we recognize revenues? Delivery has occurred or services have been rendered, performed. The seller's price is fixed, okay? And then collection is reasonably assured, all right? Now, when we get to the retail pharmacy, retail drugstores recognize revenue at the time the customer takes possession of the drugs, okay? So at that time, delivery has occurred, okay? Customer returns are not material, so they don't have to estimate sales returns. Remember, I talked about sales returns possibly being estimated and subtracted from sales to get net sales. But over here, they are indicating that's not an issue. All right, so this is it for CVS. Let's keep going. Let's get to Home Depot. And for Home Depot, we can turn to page 50. And it's 50 not in the PDF document itself, but 50 in the search or pages window. Right, so here again, we are in the notes to the financial statements, right? And here again, for Home Depot, we see the revenue recognition approach or principle. And for Home Depot, it recognizes revenue net of estimated returns and sales tax. So we're seeing what's going on here. There's estimated returns, it's subtracted, all right? At the time the customer takes possession of merchandise or when a service is performed. All right, so net sales include services revenue generated through a variety of installation, home maintenance, and professional service programs. But again, the key is a question, the disclosures regarding revenue recognition, and the point, that's the key, the point at which revenues are recognized. So revenues will be recognized at which point? The point where customer takes possession of merchandise, or the point at which the service is performed. All right, so let's keep moving on. I will look at Kimberly Clark, and here page 34 for Kimberly Clark. And on page 34, revenue recognition, sales revenue is recognized at the time of product shipment or delivery, depending on when title passes. Remember, depending on FOB, shipping point, FOB, destination, all right? Then there should be a sales agreement in place. Remember, I had mentioned that there must be a contract. It doesn't have to be a formal contract, but whether it's formal, written, or oral, there should be a contract. Price is fixed. Collection is reasonably assured, right? Okay, so that's it for Kimberly Clark. Let me get to Nike, because these are the companies assigned, and then of course you have the competitors. So for Nike, we'll turn to page 49. And for Nike, again, you see After the financial statements, we get to the notes, right? So under the notes, the first note is the summary of significant accounting policies, and revenue recognition is right here. So at what point does Nike recognize revenues? Now, wholesale revenues are different from retail store revenues. So you need to address the point in time that revenues is recognized for the different types of revenues. It's important. So you need to make sure you've addressed the different types of revenues. Here, there's wholesale revenues. So that is revenues from supplying the wholesalers. And it's recognized when title and the risks and rewards of ownership pass on to the customer. So based upon the terms of the sale, FOB shipping point, FOB destination, ownership or title will transfer at some point. So at that point, okay? Now this occurs upon shipment or upon receipt, depending on, again, the type of agreement. Now retail store revenues are recognized or recorded at the time of sale. How about online sales? Those are recorded upon delivery to the customer, okay? So you need to address all the different types of revenues. Let's see, I'll get to Pfizer. Now for Pfizer, we'll turn to, let's see, I'll turn to page 86 for Pfizer. So with Pfizer, again, we are still in the notes, okay, which comes right after the financial statements. So for Pfizer, revenue recognition is as follows. Pfizer records revenues from product sales when the goods are shipped and title passes to the customer, okay? So you need to identify the point in time. All right, let's see, I think that, yeah, we have Procter & Gamble. Let's look at Procter & Gamble. No, I believe we are good. All right, so that is it for the first part of the question. So the next is compute accounts receivable turnover ratio for your company and its competitor. So if your company is Home Depot, the competitor is Lowe's. So you need to do the account receivable turnover and days sales outstanding ratio for both of them. So let's go to my spreadsheets for each of these assigned companies and competitors. Let's see. I need to make sure I can figure out which of these is my company. Okay, bear with me one moment. Okay, so I do actually have, okay, it appears some of you or someone has some audio issues. Let me make sure that I can fix the problem. Bear with me one moment. Okay, just to make sure that if any of you are having issues with the audio. Right, let me know if you can hear me before I continue. Maybe if you can just raise your hand, use the raise hand. Yeah, okay, y'all, you can hear me. Okay, awesome. Was just making sure. Okay, good. Now, if for some reason because y'all can hear me. If for some reason you are in and you cannot hear me, perhaps you want to um, log out and then log in again and see what happens. Otherwise, you probably want to maybe uh, contact WebEx tech support. Okay. In some cases, there may be some few issues here and there. Okay, awesome. Okay, so let's continue. So at this point, we want to do the account receivable turnover ratio. Okay, and for the account receivable turnover ratio for Home Depot and Lowe's, and then of course, day sales outstanding for Home Depot and Lowe's. Now, this will be for the current year. So when you take Home Depot, for example, okay, and we get to Home Depot's financial statements, page 43, you want the current year. The current year actually is the year ended 2017, but the date is January 2018, but it's for the year 2017, right? So now you want the account receivable turnover ratio. Now, when you compare Home Depot's account receivable turnover ratio to Lowe's, you are pretty much evaluating how the two companies manage their receivables, how they collect on their receivables. If a company does better, then that company would have better liquidity. Okay, so on that score, that company is doing better, and that can help you come up with your recommendation in the company analysis. So let's take account receivable turnover, measuring how quickly receivables are being collected, amounts owed by customers. How quickly are we collecting them? Well, it's the amount owed, receivables. That's it right here. Okay. Now remember, we find the average receivables. So beginning balance for this year is this amount, ending balance is that. So we add up these two, divide by 2. That gives us the average receivables. But to calculate receivables turnover ratio, we need our net sales and then divided by average account receivable. So let's go to Home Depot's financial statements. We can do the average receivables right here. We need net sales. That's it, right here. So we are good to go, right? So net sales divided by the average receivables. Now let's look at we have Home Depot. Let's look at the days sales outstanding. That is how many days it takes on average for Home Depot to collect its receivables. How many days? You want that to be lower. The lower or fewer the days, the better. With the receivables, the faster or the higher the receivables turnover, the better, right? Okay, so how do we calculate days sales outstanding? 365 divided by the receivable turnover ratio. Again, 365 divided by that. Okay, so 365, right? 365 right here divided by all of that. Okay. All right, so we need to do that also for Lowe's. So let's get to Lowe's. Lowe's is right here. And I can get to the financial statements for Lowe's, which is on page 48. Okay, so this is the balance sheet. And for Lowe's, let's keep going. Bear with me one moment. For Lowe's, I need page 48. Okay, so this is the balance sheet. And I must have mentioned this in class. Lowe's does not carry account receivable. Let's look at the balance sheet. You have cash and cash equivalents, short-term investments. Then we get to inventory, no account receivable. And the reason is that Lowe's has contracted with GE Financial, and what happens is that all its receivables are taken over or sold immediately, are transferred immediately at the time of the sale to the financial services company, and that company takes ownership of the receivables and collects. So of course, what does it do? It would discount that amount and pay Lowe's in cash. So at every point in time, it's almost like Lowe's is making cash right away from its sales, no receivables. So that's it right here. So on that basis, for Lowe's, if there is no receivables, you can calculate the turnover. So it will be zero. You can calculate it. Same thing with the day sales outstanding. It will be zero. Okay? Now, moving on, let's look at Kimberly-Clark. So with Kimberly-Clark, we want to calculate the receivables turnover ratio. And for Kimberly-Clark, I would go to page 32 for its financials. And we need receivables turnover ratio. So the account receivable is right here. So you need the average account receivable, which is adding these two divided by 2, and then you need the sales. That's it right here. It's for the current year. So 18,259 is what you need, divided by the average sales. All right? And that should give you the receivables turnover ratio. And then, of course, see, sales divided by average receivables. Then for the day sales outstanding, how many days it takes to collect, 365 divided by whatever you got for the receivables turnover ratio. Whatever you get here, 365 divided by that. But you need to do all of that in Excel. This is only meant to remind us about the formula. That's it. That's why I have it up here. But you need to do the calculation in Excel. Right, so for Procter & Gamble, you do the same thing. P&G, you do the same thing. Let's find Procter & Gamble. Let's see if that is, yep, that's Procter & Gamble. So page 39. And that's net sales, right? Again, divided by the average account receivable. That's it. So you find the average of these two. All right, so that will be it for Kimberly-Clark and Procter & Gamble. Now for, bear with me one, for Nike and Under Armour, you do the same thing, right? So you need to go to Nike's financial statements. And then Under Armour's financial statements, and then of course identify the sales, and the sales is the same as revenues. So you use this revenues, same as sales, divided by the average account receivables, which is right here. Account receivable net. So you use the average of these two. All right, and we can also, bear with me one moment, we can also look at Under Armour, and that will be page 68. So account receivable net, and never mind the thousands, because everything is in thousands, so you don't need to put the thousands by it when calculating the ratio. So the average of these two, and then we need the sales, which is right here, and that's it. Okay, so you take this and then you can calculate the ratio. Let's see. So what about Pfizer? Okay. So for Pfizer, again, we go to Pfizer's annual report. And for Pfizer's annual report, I will go to page 78. And I have the revenues right here, divide by average accounts receivable. And the account receivable is here. Note that this is the trade account receivable. And we are using the net account receivable. So no need to bother with these numbers here. That's the allowance, remember, that has been subtracted. So these are the numbers we need. All right? Okay. So that will be it for Pfizer. And then, of course, for Merck. Let me find Merck. Merck is right here. So for Merck, I will go to page 73. And the account receivable, again, net value, we find the average, and then we need the sales. I think I have to go scroll up the first statement. Right, so we use the sales as it is right here, and we should be good. Right, so we can now move on to the next question. Bearing in mind that for CVS and Walgreens, we do the same. Again, net sales divided by average account receivables. And we just use the first line item. Okay, so for question number 2, and we will start off with CVS and Walgreens. So we asked to compute the following ratios for your company and its competitor for the past 2 years. So what that means is you have to start off with the most current year, then you go back 1 year, all right? Now, please remember that current ratio is a measure of liquidity. And liquidity is the ability of a company to pay its short-term liabilities. And this ability is dependent on the current assets the company has, okay? So current ratio is simply current assets divided by current liabilities, okay? Now, the numbers I have here are for 2015, so that will not cut. That's not what you need. So please ignore these numbers, okay? You don't need these numbers. They will not work, okay? Because let's take Walgreens, for example. Walgreens' most recent fiscal year, let's go to it, we'll see. It's 2018, so that's what you need to calculate the current ratio for. So let's get to that. Walgreens 2018, and then of course you have to calculate for 2017. So that's what you need. So you need your current assets, current liabilities. That will give you 2018 current ratio, 2017 current assets divided by current liabilities will give you 2017 current ratio. So let's get back to Walgreens. So in actual fact, what you need is 2018 and 2017. Let me highlight that, the avoidance of any doubt. That's what you need. So please bear that in mind. 2018 and 2017. For CDS, you also need to do the current ratio. Let's get to CDS. I'll go to page 46. And so my total current assets for 2017 is the most recent year, ending December 31, 2017. So it will be current assets divided by current liabilities. Then you do the same for 2016. So here again, we can compare liquidity for the two companies. The company that has higher liquidity has a better ability to pay its short-term debts, right? Now, please bear in mind that we also are required to calculate quick ratio, okay? Now, quick ratio is another measure of liquidity, and it's a tighter measure because it excludes inventory and accounts below inventory. So let's look at quick ratio. Again, these numbers are not correct. They are for 2015, 2016. Right, so for quick ratio, what we need to do is, let's look at it for Walgreens. Please remember that you draw the line at inventories here, inventories. Quick ratio will be the quick assets divided by current liability. Let me go over that. It's the quick assets divided by current liabilities, because it's believed that the quick assets are more liquid, and it's in some cases a more realistic indication of ability to pay short-term debts. Inventories may not be able to be sold, all right? So you draw the line at inventories, above inventories. Now, in Walgreens' balance sheet, you don't see short-term investments. If it was there, it would have appeared between cash and account receivable, but they don't have it, which is fine. So it will just be these two divided by current liabilities. These two for 2017 divided by current liabilities. When we look at CDS, CDS, on the other hand, has short-term investments, and as I indicated, it's between the cash and account receivable. We draw the line, pardon me, we draw the line above inventories. Above it, so the line is here. So above inventories, we use all of that. Those are the quick assets. So we use that for quick ratio. So it will be the cash, the short-term investment, and the account receivable. We add all of them up, divide by current liabilities. We add the same for 2016, cash, short-term investment, account receivable, divide by current liabilities, and we should be good. So that will be it for the quick ratio. Now, what about the gross profit ratio? That is the gross profit margin, and it's the gross profit divided by sales. Now, for some companies, you might not see the gross profit reported directly. If you don't see it calculated, it will be net sales divided by, net sales minus cost of goods sold. That gives you gross profit. I hope you remember. Net sales minus cost of goods sold, or revenues minus cost of goods sold. That will give you gross profit. And divided by net sales gives you the gross profit ratio. And we want to report it or calculate it as a percentage. So you select percentage for the answer. So let's take Walgreens again. We want the gross profit let's see. Okay, down here. So let's look at the gross profit. Okay, it's reported directly here. So this divided by the sales, this divided by the sales, and we're good. Let's look at CVS. Right, so for CVS, again, they report the gross profit. So that divided by net revenues. So that would be for 2017, all right? And for 2016, you use the numbers. So that is it for the ratio calculations. Now, once you do this, for your company analysis, you would already have calculated this. So when it comes to the company analysis, you can discuss the trend. For example, Walgreens' gross profit ratio increased, whereas CVS's decreased. Or Walgreens had a higher gross profit percentage and profit margin percentage compared to the competitor, okay? So based upon that, you can make a recommendation. It will be part of your recommendation. So profit margin ratio, it's simply net income, okay? And here, you want the net earnings attributable to Walgreens. So the net earnings that belongs to Walgreens, that's what we use. So you not use this net earnings, okay? You want the net earnings that is attributable, okay, owned by Walgreens. It's this. Because there are non-controlling or minority owners who also have access to the earnings because perhaps they own 10% of some of the subsidiaries that Walgreens has invested in. Walgreens has 90%, they have 10%. So 90% of the earnings is for Walgreens, 10% for the non-controlling interest. So we use this, okay? So in this case, it will be 5024 divided by 131,537. Again, it's the net earnings attributable to the Walgreens Boots Alliance or the company, whichever company, divided by that. Let's look at CVS. We see the same scenario because these are consolidated financial statements. So it will be net income attributable to CVS Health divided by net revenues. Let's look at Pfizer. So for Pfizer, let's see the net income. Right, so here you also use net income attributable to Pfizer. That's it right here, divided by the revenues. So that will give you the net profit margin or profit margin ratio. Let me get Pfizer right here. I believe that's Pfizer, right? So for Pfizer, again, you are using the net income divided by net sales for the profit margin ratio, right? So again, it's the net income attributable to Pfizer. If it's Merck, it will be net income attributable to Merck divided by the sales, okay? We've already discussed the ratios for each of these, for each of them, right? We already discussed that, so I think you should be good to go. So let's move on to question number 3. And I'll focus on Pfizer and Merck and then move on to another company. So in question number 3, you are asked to complete the following table with sales reported for the past 3 years by your company and its competitor, in actual fact. Let's look at Kimberly Clark also. Okay, so it's by your company and competitor. So let's look at that. Let me refer to the question. Yeah, your company and competitor. So you want to do both of them. So I return to Pfizer. So you want to report the sales for Pfizer for the last 3 years. So it's a matter of just looking at the income statement. Okay, so that's the sales, 2015, 2016, 2017. Now, for your company analysis, that is after this company assignment, you can then look at the trend in the sales. Which of these companies reported a higher percentage increase in sales over a 3-year period, okay? But for this assignment, all you are doing is you report the sales, okay? Okay, so you do the same for Merck. So Merck is right here. Again, the sales for 3 years. We can pick Kimberly Clark and Procter & Gamble. So let's take Kimberly Clark. Again, the sales for 3 years, right? And then for Procter & Gamble, bear with me one moment as I find Procter & Gamble. Let's see. Yeah, that's Procter & Gamble. And for Procter & Gamble, you also report the sales. So you may see in some cases, sales might have dropped or sales just increased a little bit. Okay, for Procter & Gamble, 2016 to 17, sales actually dropped a little bit, then increased a little bit in 2018. Right, so moving on, let's look at the next part of the question. Find item 7 of the annual report on Form 10K. 10K is the annual report. This section of the annual report is the MD&A, Management Discussion and Analysis. Okay, now briefly in your own words. Okay, bear with me. Okay, so briefly in your own words, describe the reasons given for the increases or decreases in sales that have been reported, which you capture here for the past 2 years. So what you need to do is, you need to look at the MD&A, which is under item 7, and I would illustrate this. Let me take Lowe's. Okay, so I have Lowe's. Now the management discussion and analysis is at the first or top part of the annual report before you get to the financial statements. So as you scroll through, you find it. Okay, it comes before the financial statement, and it's item 7. You could even look at the table of contents, and there might be a link such that when you click on item 7, it will take you there. So for Lowe's, I do have, let's see. So for item 7, I'm looking at the sales trends, right? That's what I want to find. And let's see where I am. Okay, so when you're searching, you see the sales, okay, right. So you see the sales being discussed. So here is fiscal 2017 compared to 2016. Net sales increased 5.5% to 68.6 billion in 2017. The key information you're looking for is the reasons for the increase or decrease. In this case, the increase was driven by 4% comparable sales growth. The addition of an acquisition, Lowe's acquired Rona, R-O-N-A, is right here, during the second quarter. So with those new stores and acquisition, its sales bumped up, okay? So that's the discussion. Then of course so you just summarize the key points. For fiscal 2016 compared to 2015, what accounted for the increase or decrease? Remember, you're looking at sales for 3 years. Well, net sales increased 10.1% from 2015 to 2016. And the increase, again, is attributed to the addition of Rona. That's the acquisition. Lowe's made an acquisition. Okay? So the key reasons is what you want to focus on. All right? Now, let's take Home Depot. Or rather, I'll skip Home Depot. I'll just get to Under Armour. Okay, so Under Armour, because I haven't looked at Under Armour in a while, page 46. Again, this is under the management discussion and analysis. Okay. All right. So as you scroll through that, you get to the section where the management discussion of the results of operations, of revenues or sales. Okay, so here it's explained. Net revenues increased by this amount of 3.1%. The increase was driven primarily by these factors. That is your focus. Now, in a practical analysis, you want to look at the reasons for the increase, and then you make a judgment call whether those factors that cause the increase would continue to apply going forward. If those factors will not apply going forward, and another company has factors that appear to, be factors that would recur into the future, then that other company, the competitor, could perform better than the other company, okay? So these are some of the ways to look at things practically. All right, so that's it for Under Armour. So we see how to pick the information you need for this particular question. I would look at one more, and then before we move on to question number 4. I'll take Pfizer. So Pfizer, I'll go to page 23. So again, this is management discussion and analysis, but Pfizer refers to it as financial review, okay? So again, you want to get to the section where the company is discussing its operations and revenues in particular. Okay, so revenues of overview. Compared to 2016, revenues for 2017 were unfavorably impacted by $200 million as a result of 2017 having one less selling day. So this is one factor, okay? Then there was foreign exchange rate fluctuation impacting the sales. So you may see foreign exchange rate fluctuation bumping up sales or dropping sales, all right? So you want to, again, identify the reasons. Okay, so let me move on to number 4. And with number 4, I would, let's see, I think I will now look at CVS. Okay, so number 4 requires you to complete the table the following table rather, using data from the statement of cash flows for your company and its competitor. And you are required to record the cash flows from operating, investing, and financing activities for the current year, for the prior year, and for 2 years prior. So for a 3-year period. Do the same for the competitor, in this case, CVS and Walgreens, okay? So how do we go about it? Let's take CVS. You go to the statement of cash flows. And here you are looking at the trend in the company's cash flows. That should tell us whether the company may have cash flow problems or it's doing a good job managing its cash flows. So operating for 3 years. So these are the numbers, right? Investing for 3 years. That's it. So you can see investing negative 13,420, then it comes to negative 2,470, and then negative 2,932. Of course, in millions. So this is actually in billions, but of course you can leave the numbers as they are, and then just put in parentheses millions. Then financing. So financing cash flows was positive in 2015 for CVS, then negative 2016 and 2017. So let's get back to CVS. So that's what you do. You do the same for Walgreens. Now, the next question is briefly evaluate trends in cash flows provided by or used for operating, investing, and financing. One quick point before I continue. Please make sure that you get your signs right. If investing is negative for the current year for CVS, put negative there. You can use the formatting to make negatives stay in parentheses. So the negative cash flow or negative numbers could be in parentheses, or you could just put a negative by it. Right, so briefly evaluate trends in cash flows provided by. Provided by is positive cash flow. Used is negative cash flow, all right? So in some cases, investing cash flow would be negative because the company is making expenditures, capital expenditures, acquiring buildings, equipment. So it becomes negative cash flow. Cash is going out. So you have to evaluate the cash flow trends for the 3-year period for the company and competitor. Now, to get the information to help you do the evaluation, and it's a brief evaluation, you need to go to the management discussion and analysis section. That's the first section of the financial statements. And you go to the liquidity and capital resources section. So where is that? Well, let's take Lowe's, for example. Again, this is the front end. That's it. That's where I am right now. Okay, front end. You keep scrolling, and for Lowe's, it will be on page 34. As you scroll, you find it. Or you can just put in, use the find, okay, and then you type in liquidity and capital resources into the search window, okay? So liquidity and capital resources, you type that into the search window, and you'll be able to find it. All right, so this is for Lowe's, liquidity and capital resources. Now, what you're interested in is the discussion on cash flow, operating, investing, and financing trends, and the reasons for the trends. So cash flows from operating continue to provide the primary source of liquidity. That's fine. The decrease, and we see the decrease, let's see, from 2016 to 2017, operating cash flows dropped, okay? The decrease was driven primarily by changes in working capital. But this was partially offset. So it could have been very bad but it was offset by increases in profits adjusted for non-cash expenses in 2017. Okay, but primarily by changes in working capital. What does that mean? Remember the indirect method that was used for operating activities cash flows in our assignments. Now, when we do the adjustments, we adjust for increases in account receivable or decreases, increases in accounts payable or decreases in accounts payable. All these accounts are working capital accounts. So those changes, okay, cause the drop. So remember, when account receivables bump up, it reduces operating cash flow. I repeat, when account receivables increase, operating cash flow drops. Okay, so that could be a factor over here. All right, so then we get to investing. The reasons are stated here. There was capital expenditures. Then we get to financing. They talk about, let's see, financing cash flows. They talk about short-term borrowings, share repurchases, when the company buys back its own shares, and then the payment of dividends. Okay, so the information is right there. Let's take Procter & Gamble. So for Procter & Gamble, again, we are in the management discussion and analysis section. And remember, it's the liquidity, cash flow, financial conditions section, or liquidity section. You do a search, you'll find that under management discussion and analysis. So here again, operating cash flow. The discussion is there. The reason, there was a 17% increase. And the increase was due to the following reasons. It's listed. Okay? So then we get to financing and investing. Okay? So investing cash flow. Net investing activities consumed $3.5 billion in cash in 2018 because of capital spending and purchases of short-term investments. Okay? So again, the discussion captures the reasons. So just find that information. For example, Walgreens will have that on page 51. You see liquidity and capital resources. Here again, you see the discussion, see, for net cash used for financing activities, 2018 compared to 2017. Okay, and the reasons. Company repurchased shares. So as it is repurchasing shares, it is using more cash. That's negative. Net cash used for financing, for investing rather, activities. Okay, so the reasons for the change is also explained. And then of course, operating. All right, let's see. I can talk about, let's see, I can talk about Nike. For Nike, I'll just go to page 35. See, liquidity and capital resources. So you can again do a search, find, edit, find, just put that in here, liquidity and capital resources. You start off from the top, from page 1, it will take you there, okay? So again, you see cash provided by operations. The discussion of the reasons is right there. Right, so with that, I'll move on to the last question. Let me make sure I've addressed question number 4. Yes, I've addressed it. So question number 5, which is the very last question, you are to find the disclosures regarding inventories. And specifically, what cost flow assumptions does your company and its competitor use? Does your company use the LIFO cost flow assumption, the cost is flowing, the inventory cost. How is it flowing out? Remember, we have LIFO, we have FIFO, we have the weighted average. Okay? Then you have to calculate inventory turnover ratio. How quickly inventory is being turned. That is, how quickly inventory is being sold. That's the inventory turnover ratio. And we can calculate the number of days it takes on average to sell the inventory. You want to take fewer days. So the fewer the days, the better, right? But with the turnover, the higher generally, the better. So let's start off with the inventories. And I would start off with Kimberly-Clark. So going to Kimberly-Clark's financial statements, because I have the financial statements over here, let's look at the inventory turnover ratio right away. Inventory turnover ratio, it's the cost of goods sold divided by average inventory. So this is the inventories, right? The average is right here. So you find the sum of these two divided by 2. That's the average. And then it's cost of goods sold divided by the average inventory. Cost of goods sold right here. 11,706 divided by the average inventory. Right? So that will be for Kimberly-Clark. Okay? So you do that, and it should be good to go for the inventory turnover ratio. Then you need days sales in inventory, or average days in inventory. 365 divided by the turnover ratio. Now let's go back to Kimberly-Clark, and now I will look for the notes to the financial statements, and the notes is right here. So in the notes, we are looking for the inventories. I think I have to go up. The inventories valuation method. That's it right here. It's always at the top of the notes. So inventories and distribution costs. Most inventories in the US are valued using last in, first out. Outside the US, you can't use LIFO. So I guess outside the US, they use first in, first out. So those are the cost flow assumptions. Now we know how the assumption used, the inventory method used affects profits. Okay, so let's see, I can look at CBS. So again, I'll go to the notes. And we want the inventories cost flow assumption that is used right here. It's here. Inventories are stated at the lower weighted average cost. So that's the cost flow used. LCM, that's lower of cost or market, is taken care of. Okay. So again, for inventories cost flow, CVS uses the weighted average cost method. I can look at, let's say, Merck. Now for Merck, we want the inventory turnover ratio. Again, remember the inventories for the current period and the prior period. This will be the beginning balance. This will be the ending balance. Add the two, divide by 2. That gives you the average. And then, of course, cost of goods sold here. This is it. Cost of the materials and production. That's it. So you see, you are not saying cost of goods sold explicitly. So you need to be careful. For Merck, it's the cost of the materials and production. That's it right here. Okay? So that's it. cost of materials and production. So this divided by the average inventory, the average of these two numbers, it should be good to go. Now, in terms of getting into the notes, we want the inventories method. It's LIFO and then FIFO. Okay, so we see that for let's see. So let's move on to Procter and Gamble. Now with Procter and Gamble, I get to the notes again. You can easily find the inventories. Yep. Okay. Let's see. Revenue recognition, cost of products sold, SG&A, investments, inventory valuation. That's it right here. Inventories are valued at the low of cost of market, but we want the cost flow assumption. It is first in, first out. Okay, so that is it for Procter and Gamble. So you can do that for all the other companies. Okay, and then of course back to the financials. You want inventories. Let's be careful here. Procter and Gamble manufactures its inventories. So you have materials and supplies, you have work in inventory, unfinished inventory, and then you have finished goods inventory. So please, when you have that, you need to use total inventories. That's it right here. Total inventories. Okay, 4738, 4624. So you add up the two, divide by 2, that gives you the average. Then cost of goods sold divided by average inventory. So that's how quickly inventory is being carried. All right. So that's pretty much it for this discussion. Any questions? Let's see. Okay, where do we find the cost flow assumptions information? So I think I clarified that. Any other questions before we wrap things up? This has been quite long, but I think it will be very helpful. So I put, as you can see, the formulas are right here. And once again, let me just emphasize that these ratios you are calculating for the assigned company and competitor would help you do the company analysis. So when it gets to the company analysis, all you'll be doing is you pretty much will be discussing the ratios you've calculated. All right, and okay, so I want to thank you all very much for your participation. If you were not able to participate, please listen to the recording and just follow along and you should be good. So we'll meet in the class, and if you have any questions, please reach out. I'm here because of you. Have a good night.